What is return on net assets? Return on net assets is a measure of financial performance, and actually it's an extension of traditional return on assets ratio. Return on net assets measure how well a company's fixed assets and net working capital are generating net income. Return on net assets is commonly used for capital intensive companies and is an important ratio looked at by investors and analysts to determine how effective and efficient the company's assets are. So we can say return on net assets is a performance ratio which compares the income generated by a business and the fixed assets used to generate the income. For many companies, fixed assets are the biggest component of investment. Hence, it is useful to understand how much income these assets are producing. And it's also useful to understand if the company is effectively using its resources or losing money on incremental investments. So better utilization of assets can generate high returns, making the company more profitable and increasing the ability of the company to return the money to investors. The formula for return on net assets is net income divided by fixed assets plus net working capital, where net income is a company's income minus the operating expenses, that is cost of goods sold and selling, general and administrative expenses, and taxes. Taxes are always deducted from net income because it reduces the net income to the investors or common shareholders. Fixed assets are assets purchased for long-term business use. And third, net working capital is the difference between company's current assets and current liabilities. Things to remember. You might be wondering that why the average net assets is not on the denominator. Okay, let me tell you. First, we don't consider or take intangible fixed assets in denominator because they don't contribute on the production and they are even on balance sheet just because of acquisition of some other company. And secondly, the current liabilities can be netted out to put more emphasis on long-term capital. That's why we calculate net working capital instead of taking all current assets for the calculation of return on net assets. There is no ideal return on net assets ratio. Generally, the higher this ratio is, better it is. Higher return on net assets may imply that the company is using its assets efficiently, and an increasing return on net assets may indicate an improving profitability and financial performance of a company. It is important to compare the return on net assets of a company among peer companies or with index average. Let's take an example to understand it better how to calculate return on net assets. So assume revenue 5 billion per rupees, expenses 4 billion rupees, current assets 2 billion rupees, current liabilities 1 billion rupees, and fixed assets 4 billion rupees. So in solution we can see that the formula of net income is revenue minus expenses, which we need for the numerator of the formula. So if we deduct revenue minus expenses, that is 5 billion minus 4 billion, it gives us $1 billion of net income. And second, net working capital is required on the denominator side of the formula, which is current assets minus current liabilities. So if we deduct 2 million minus 1 billion, that is 1 billion, which is a net working capital. And in question we already know our fixed assets is $4 billion rupees. So total denominator would be 5 billion rupees. So if we put all these three amounts in our formula, that is return on net assets, then we will get 1 divided by 5 billion rupees is equal to 20%. Okay, I hope you all get it. So that's it for this video. I hope it would have helped you to understand this topic even a little bit. And if you have any queries, please tell me on the comment section. I will try to solve it for you.